Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, how are we going with time? I think, 5:05, time to start the lecture. Okay, well, what are we having a look at this week? Oh, now what I should do is the lights, right? Because you've told me this is better, right? Okay, good, right? Excellent. So what we're going to do is finish ordinary income, right? Well, it's largely ordinary income, right? There are a few instances of statutory income too. And then specifically, we're going to look at CGT, which is a form of statutory income. But what we're doing is, well, how we analyse this topic is we divided it in a way that's conventional in the textbooks, looking at personal exertion income, business income, and now we're looking at property income briefly, okay? Now, let's make it interesting, let's make it interactive, right? Because you've got readings in your text, and I hope you have access to some kind of a text, even if it's a previous edition, right? So, interest on a loan, is that income? Just shout it out. Is it income? Is that going to be income? Is that going to be assessable income? Yes, fantastic. Most definitely. Even in week 1, this is an example we gave of income, right? Interest flows from a capital asset, right? And the capital asset is the loan. So interest is assessable income, and that is a fairly straightforward principle. So in terms of the cases that go to court, it's more unusual cases. And the point from this case, FCT and Hurley Holdings, the point that the court made is that in considering whether a receipt is interest, the court takes a substance over form approach. That is a very common expression used in the law, substance over form. What that means is we focus on the true economic meaning of a transaction, right? Rather than the language of the parties used if it appears that the language is not consistent with really what is happening in reality. Courts don't pay much attention to the language or how an agreement is structured. They focus on the substance. Now, here you see that the taxpayer purchased a discounted bill for $442,200, right? Now, there was no designated interest amount under that bill. However, 12 months later, they were going to be entitled to $500,000, right? Now, if you invest $442,200 and a year later you get $500,000, even if the agreement does not specify that there is interest, in economic reality there is interest because money has a time value, and if you are getting $57,800 more after 12 months, there is in effect interest. It's 13% interest and it's assessable. Substance over form. The courts can recognise a receipt as interest even if you don't call it interest, right? Economic substance, that counts. Welcome, I'm so pleased to see tax clinic interns at our lecture. I was talking about the tax clinic earlier. Raise your hands. Yeah. Redeemer? And sorry, can you tell me your name? Oh, Tanish. Wonderful. And? Gloria. I'm going to write down your name in the break. These are our tax clinic interns. I was promoting my goodness. So, look, book an appointment. Get help, right? Because it's not it's these very capable people. And as well, they're going to be supervised by a tax accountant, right? You want to help, don't you? Wonderful. Okay, great. Now I'm so happy to see you. Okay, let's keep going. Dividends, right? Now, okay, you tell me, are dividends income? Right? Don't worry even about the detail on the slide. Are dividends income? Do you have to pay tax on dividends? Yes or no? Shout it out. Yes, absolutely. We mentioned this in week 1, right? No doubt about it. A dividend is a flow from a capital asset. The capital asset are the shares, right? Now, dividends are ordinary income at common law. However, because there is a special statutory provision governing dividends, they are technically statutory income, and we cite the statutory provision, Section 44 of the 1936 Act, as our authority for dividends being taxable income. Okay, good. Now, let's keep going. So what we're doing, Tax Clinic interns, is we're just going through categories of property income. Okay? Generally, it's fairly straightforward with our category, with property income, so we're not spending that much time on it. Rental and lease income. Okay, now this is again an example of income that we all recognized, according to common sense, I think, in week 1 as income, right? No doubt about it, it's a flow from the capital asset. The capital asset here is the property, right? Now, so it is ordinary income, so the only tricky cases you get that go to court are unusual cases. Now, where sometimes it could be that, again, that parties create some very strange-looking agreement, and there could be a payment that one party pays the other. They may not call it rent, but if it's actually a payment for occupying a property, and there is a payment from one party to the other in relation to that, the courts may treat it as rent and assessable. Now, another kind of payment we will look at here are lease premiums, right? So a lease premium, now this is not exactly rent, but it's related. Now, this is an amount paid by a lessee to a lessor, right? From a tenant to a landlord, a lease premium. And this is to really to persuade the landlord to grant the lease, right? Sometimes there's a very high demand for leases. Now, the general rule with lease premiums is that they are treated as capital, right? However, in some cases, and they will be the minority, as per the Kosciuszko-Threadbow case, if you've got a landlord who regularly receives lease premiums, right, then the court may come to the conclusion, as it did in the Kosciuszko case, that, well, this is an ordinary business proceed because it's part of the landlord's regular business. So it was treated as ordinary income. But the general rule with lease premiums is that it's a capital receipt, which, what does that mean, capital receipt? You have to think about the CGT regime and how it's dealt with there. And we will get to that, although we will not look at lease premiums in any particular detail, but I'll show you the relevant provision. Okay, royalties. This is another one we mentioned very early on as an example of ordinary income. Royalties, we classically think of a periodic payment for the use of intellectual property, such as copyright, trademarks, patents, right? Now, most of the time in life, that's what a royalty is. it relates to intellectual property. But it is actually broader in terms of its definition, and it means at law it's a payment made for the use of an asset calculated by reference to the quantity of the asset taken. So most of the time we're dealing with intangibles and specifically intellectual property. However, you can get cases where you see royalties that relate to the use of tangible items, okay? So, for instance, there is this Macaulay case. It's at page 297 of your book. In this case, the taxpayer sold the right to cut timber from his land, right? So timber, it's a physical thing, and that was for a payment of 3 shillings per 100 feet. That's a royalty. Normally we think of intellectual property, but it can be that what you're selling is some physical item, here, timber, and it's a royalty, right? If it's a payment calculated by reference to the amount that someone else takes, and it's assessable as ordinary income. And the relevant provision is Section 6.5 of the 97 Act. Now, this is for your information point. There is a specific statutory provision concerning royalties, Section 1520, right? It applies to royalties at common law, it says, but it's essentially redundant. It's not necessary in the law because these royalties at common law would be assessable under Section 6.5 anyway, right? We do have this in the law, some redundant provisions, because the Parliament has a lot of work and they have policy agendas, and I suppose they're more concerned with remedying injustice rather than, you know, getting rid of unnecessary provisions which are not a, you know, top priority for them. Now, let's look at annuities. Now, from your accounting and economic studies, you're familiar with annuities, right? Is that true? Thank you. So, an annuity, it's a stream of payments that occur at regular intervals. It could be yearly, it could be monthly, quarterly, right? Now, an annuity, it is established as income, right, at common law. Now, there's a specific statutory provision that governs annuities. Because that specific provision exists, that's what we use as the basis for taxing annuities, right? So now, this is a very useful provision. What Section 27H of the 36 Act provides is that, well, it not only tells you that an annuity is assessable income, it also very usefully tells you, the taxpayer, that in working out the assessable amount of your annuity, you are entitled to subtract what's called the deductible amount. What is this deductible amount? It is the amount of the annuity that represents your return of capital, right? Because the thing is, when you buy an annuity, okay, and you're buying a future stream of payments, see, with the payments you get back, there will be a capital component and an interest component. That capital component, it's not taxable. That makes sense. That's not income because that's just your money coming back to you, right? So you should only be assessed on the interest component, right? So we're going to look at an example which shows you how you calculate this deductible amount, that is the return of capital to you. And so it's the annuity payment minus this deductible amount, right, gives you the interest component, which does go into assessable income. So the example, it is from 9.13 of your book. If you brought your book, you can turn to it, right? So it's at 9.13. That's the example number. Now, if you didn't bring your book, well, it's at page 299. It doesn't matter. I'll tell you the facts. So Stan pays 80,000, right? 80,000. So that's the purchase price of the annuity. That's B in the formula. He pays 80,000 for an annuity. The term is 8 years, so that's D, right? So the denominator is 8. Now, what he gets is a payment of 13,000 per annum, right? And he's not entitled to any residual value at the end of the annuity term, right? So can we go through this formula, plug in the amounts, and then work it out? Now, A, that is going to be 1. Most of the time, A is 1. A refers to, well, the ownership interest in the annuity. It is only going to be something other than 1, say 50%, that is 0.5, if you are co-owners, right, with the annuity. So in this case, it's 1. It doesn't make a difference to anything. So the inputs are, it's 80,000, right, that's the purchase price, minus 0, no residual value, divided by 8, right? So $10,000 is the return of capital, 10,000, right? Now, I said the payment, the annuity payment is 13,000, right? Now, so 10,000 is, that's the deductible amount, the return of capital. So what is the assessable income amount? 3,000, fantastic. 3,000 is the interest. So when we have our $13,000 payments, right, 10,000 is the return of capital, 3,000, that's the interest component. That's what you put into assessable income. Okay? And that example, it's in your book, so you can look at it in your book as well. Okay, now we're going to, yes. Sorry? An annuity due, is that a technical term? Right, right. That might be a, so with the annuity due, is it the case that there is more than one point in time when you're making, when the purchaser? Yeah. Oh, okay, okay. I think it would be the same treatment. Yeah, yeah. But if you show me, like even in the break, more detail, I can confirm that. Okay, let's go to the capital gains tax regime, right? Now, this is incredibly important, right? This is always examined, often in a lot of detail. By detail, I don't mean that every part of this topic will be examined in detail, but there are certain critical aspects, and it's really important to bring it all together, right? And I'm going to emphasize some really important points, and it's really conducive to problem solving. And you'll get one big problem on capital gains next week. Right. Now, with the capital gains regime, I mean, what we have to first recognize is this is fundamentally different from ordinary income, right? I mean, this is not coming from judge-made law, from the common law. This is from the statute, which says that capital gains are taxable, right? In Australia, now we've had it for a long time, but we haven't always had it. So the CGT regime came into effect in Australia on 20th September 1985. The date is important because in general, if you've got assets bought before that date, it's going to be CGT exempt. I mean, I'm saying in general because there are so many different types of CGT events, right? Apart from sales, there are so many different types of events. But if we concentrate, and we will in this course because it is the most common, on sales or disposals, that is, say you've got some land, right? It applies to other property, but say you've got some land and you sell it. Now for sure, this is a 100%. If that land was purchased before 20th September 1985 and you sell it today, it will be exempt from CGT, right? It must be the case that you bought it, right? Or you acquired it, right? So look, it's getting, I suppose, it's getting less relevant, the exemption, because we're getting further and further away in time from that date. Okay. Now, this next point, it's so important, and I will keep saying it, right? Note that provision, Section 1025 of the 97 Act, right? That is, I mean, the core provision with capital gains. It says a taxpayer is required to include their net capital gain in their assessable income. Right? We talk about capital gains and then we talk about net capital gains. You make capital gains or capital losses in relation to individual transactions. When we talk about the net capital gain, we're talking about the net result, right? Because there's this process. You look at, you know, your capital gains or losses for the income year, right? And for problem-solving purposes, we will give you a taxpayer which has had many capital gains events in the year. And then there's a process you go through to work out, you know, what is the net position? Is there a net capital gain or a net capital loss, right? So that's the difference, right? When we talk about capital gain, capital loss, we're just talking about an individual transaction. 1025 is saying, well, once you work it out, and there's some steps to follow to work it out, that if you have a net capital gain, it goes into your assessable income. Now, capital losses, there are some fundamental points. A capital loss is not a deduction, right? We're going to do deductions after this topic. So that's a very important point. It's not a deduction, but it has a tax benefit because a capital loss can be used to reduce a capital gain, right? So functionally, if you have a capital gain, in terms of economic substance, a capital loss behaves like a deduction functionally if you have a capital gain. But the thing is, it is fundamentally different. If you've only got a capital loss and no capital gains, then so you're in a net capital loss position. You can't use that net capital loss this income year. Yeah?
Is there something known as short-term or long-term capital gains or losses in Australia, or is there only one capital gain, capital loss? Sorry, the follow-up is, if there is, then
Yeah.
Is it short-term to short-term or long-term to long-term, the offsets?
In Australian tax law, there's not a concept of short-term or long-term as such, but, and perhaps this is of relevance to what you're asking generally, you can carry forward capital losses indefinitely, right? So say you've got a capital loss for the year, you can't use it this year, you haven't got a capital gain, you can carry it forward forever, right, and utilize it in the future. Yeah? Okay. Right. Now, the trigger condition for application of the CGT regime, a CGT event, right? We need a CGT event. And you know the most common CGT event is the disposal, A1, right? You're going to be so familiar with that term, A1. I mean, it's the case in life. More than 90% of CGT events are CGT event A1, a sale of something. Sale of land, sale of shares, a sale of any property, right? Okay, so you know I've said 1025 is super important. It is the provision which says a taxpayer has to put their net capital gain into their assessable income. Section 1025 also gives you the order of steps to work out what is your net capital gain or net capital loss for the income year. Now, bear in mind, for most taxpayers, is that true? No, most might be an exaggeration, but say for a majority of Australians, I would expect in most years of their lives, for a majority, they don't have any capital gains or capital losses, right? I mean, to give you an idea that it is not that common, now in the days when we had hard copy tax guides, right, the instructions about how to deal with a capital gain were in a supplementary section, right, that weren't in the normal tax guide, right, because it's not relevant for a majority, right? So to have a capital gain or capital loss is somewhat unusual for a majority of people. Now, so for a lot of people, this is not relevant, but it could be relevant, right? Whenever you sell an asset, you do have to think about it, right? And for the purpose of problems, as I said, we're going to give you an extreme scenario where you've got one person where she is selling a lot of things in one income year, right, for you to be able to apply the law. Let's look at this order. Now, note those steps. The first thing we do, you look at, all the transactions for this person in the year. Now, any capital gains made during the income year are reduced by capital losses during the year, right? The current income year for which tax is being worked out, right? Then then what do? Then you look to see, right, is there a net capital loss from a previous year? If there is, you can use it, right? Now, we are assuming, if we've got to step 2, that any capital losses from this year weren't sufficient to completely wipe out the capital gain from this year. Okay, so then 2, you go to prior year losses. Now, step 3, you consider, is the CGT discount applicable? Right? Now, individuals have a 50% CGT discount if they've held an asset for 12 months or more. They can reduce the gain by 50%. Companies, as a general rule, are not entitled to the CGT discount, but companies may be entitled, well, they are entitled to the CGT discount if they fall within the definition of a CGT small business entity, which means you need a turnover of no more than 2 million. Okay, we'll make that point again. And there are certain other entities apart from, trusts, superannuation funds that are entitled to the discount too. Right. You consider whether small business concessions apply. I've sort of just touched on this already, right? That in saying that companies who are small, CGT small business entities can get the discount. If you have a small business as an individual or a company, right? Okay, and now you have got to be under the 2 million, right? You get an even better discount. It works out to a 75% discount, okay? Now, then step 5 isn't really much of a step. What happens here is that basically you've reached the answer. If you've got anything left, right? So you've used losses, you've discounted if you can. Have you got anything left? If you've got something left, that's your net capital gain for the income year. Right? Now, look, what can I emphasize? Okay, it seems that even when I emphasize it, students don't perfectly implement it, but perhaps I will just continue to stress it, right? that you have to follow this order, right, in working out the net capital gain. You have to follow it because it is the law. It's the order of steps prescribed by the law. A common mistake, very common mistake, is that students will apply the discount before utilizing losses, right? It makes a difference to the answer, right? It actually makes a difference, right? But the most important thing to know is you've just got to follow the steps in the law. Now, let's look at the general rule, right? Thank goodness, this is common sense, right? When do you make a capital gain, right? Now we're talking about at the individual transaction level, right? Say, just think of, you know, a sale of land or a sale of shares or any other asset you want. When do you make a capital gain? Okay. Basically, you look at what price you sold it for, right? Which we call capital proceeds, right? Or, you know, most of the time it's some cash price that you're getting. In unusual cases, probably more common in a commercial setting, there could be consideration that comprises cash and non-cash benefits. If there's a non-cash consideration, it's got to be valued, right? So what you do is you look at what you received, right, from the buyer if you're selling something, that's capital proceeds, and you subtract your costs associated with the asset, right, which in law here we call your cost base. It is a very comprehensive notion of cost. It includes acquisition cost, of course, but it includes other items of cost as well, right? Incidental expenditure relating to the asset, right? Additional capital expenditure that may have been expended, right? Now, a capital loss, when do you have that? It's where capital proceeds, that's what you're receiving for the sale of your asset, you can think of it as that, are less than what we call, now here's a technical term, where it's less than the reduced cost base. But even though we've got that technical term there, and reduced cost base, it's a defined term in the legislation, nearly all of the time, reduced cost base is the same as cost base, right? And functionally, reduced cost base is cost and is still a pretty comprehensive concept of cost. You know, of course, it has the acquisition cost, it has incidental expenditure, it has further capital expenditure. The only way in which it's different from cost base is that it doesn't include what we call element 3, right, which is costs incurred during the life of the asset, right, such as interest expense, repairs, interest if you borrowed funds to buy the asset. Yeah, so there's one element that's different, but essentially it's a pretty workable notion of cost there. Now, in relation to each CGT event, there is actually a provision which tells you exactly how you calculate the capital gain or loss, but this general rule applies most of the time, and it certainly applies to our most common CGT event, which is A1, the disposal. So, just to give you a sense of the law in this area, a taxpayer makes a capital gain or loss, as I said, I think I said this earlier, only if a CGT event happens to the taxpayer, right? Now, I'm giving you this list to let you know that, in fact, the law is pretty complex, and it is certainly the intention of the government to regulate capital gains very comprehensively. And in terms of how you can make capital gains according to the law, it's not just with respect to disposals. You see right at the top, 104A disposals, that's sales, right? Probably 90% of cases or more are sales. It's a 104A. But there are all sorts of other CGT events in the law as well. In this course, we're just going to go through a couple more, right? We're not going to go through this whole list. And we will be focusing on 104A disposals. Right? Sometimes, at least in 1 year, in a take-home exam, I drafted a question where a special CGT event that we hadn't covered in lectures was relevant, right? And it was in fact 104I, Australian residency ends, because I think it's very interesting how that applies, right? So, look, I'm not sure what I will do this year, because I haven't written it, in terms of the take-home exam, but if I decide to include an I1 in particular within that is relevant, that then I might give you a hint in the lecture, right? Like, you know, just get you on the right track, right? So you can see I'm giving you my ideas about the take-home exam, that if I can possibly throw that in, I might, but I'll give you a further tip, right, once I've actually thought about the take-home exam in more detail. Okay. CGT event A1 disposals. I've said this is, you know, the most important event, right? I mean, it's a funny word, disposals, right? But it's, you know, it sounds like we're throwing something in the rubbish, right? And the garbage. But in law, what disposal means is a sale of something, right? So you can write sale, right, if you don't like this word disposal. It means a sale. What it means is that there is a transfer of ownership from one person to the other. That's what we mean by a sale or disposal. There's a change in ownership, right? So we're not talking about a lease. We're talking about really the most serious kind of property transaction you can have, a change in ownership. Okay. Now, look, most of the time it's because parties have entered into a contract, right? Like a contract of sale. But very occasionally in the law, look, but the legislation wants to cover every scenario. A change of ownership very occasionally could happen through operation of law, you know, as sometimes it could be the law says that there has been a change in ownership. We're not going to look at those scenarios, right? And, you know, the legislation also provides there's no change in ownership if you stop being the legal owner but you continue to be the beneficial owner. What does that mean? Well, really we're talking about a situation where a trust is created, right? Where one day you just own property, say you own land, but then the next day the situation is some, you know, agreement or, you know, document perhaps has been executed whereby there's a trust situation created where someone else becomes the legal owner and they're holding the property on trust for you. You're the beneficial owner. So what the law says here is that, well, if you continue to be the beneficial owner, and beneficial owners are entitled to the economic benefits of the asset, then there's no disposal, right? The law is looking at substance, the real substance of the issue, and there's no CGT event, which is good. Means you don't have to pay capital gains tax. All right. Now, you know the general rule that we presented, right? That you make a capital gain when capital proceeds are greater than cost base, right? So it's exactly stated here, but in the specific provision which relates to disposals, right? So disposals, that's in 104.10, right? And 104.10.4 says make a capital gain if capital proceeds relating to the disposal are greater than the cost base, and a capital loss is made if the capital proceeds are less than the assets reduced cost base. Now, I just realized I must emphasize something. We talk about capital gains tax, we talk about CGT, but CGT is not actually a separate tax, right? It's not actually a separate tax. There's no special rate that applies to your net capital gain. So we have this whole regime in the law about taxing capital gains, but just from what we've said earlier, right, how that works in terms of the mechanics is your net capital gain goes into assessable income, right? And then you are taxed at the marginal rates applicable to you, right? So it's not actually a separate tax, although in terms of how we speak about it, it sounds like it. It's not a separate tax, right? Something like GST, it is a separate tax, right? Not CGT. With CGT, it is a separate regime. There are separate rules, but the end outcome is if we have a net capital gain, it goes in to our assessable income. And we'll pay tax according to the, the marginal rates that are applicable to us, right? Sometimes it can be that your capital gain is so big that it changes your marginal rate, right? Entirely possible. It could be you don't have any income. You weren't paying any tax, but you make a huge capital gain in 1 year, say it's $500,000, you'll have to pay, 45% tax on it, then plus, Medicare levy, right? So the capital gain itself can totally change what your marginal rate is, but say if it's just a small capital gain, you might not change tax bands, right? Now, examples of other CGT events, we're just doing a couple, right? So, and CGT event C1, well, I thought I might do that one because, it's not that uncommon. You'll come across it from time to time, and it's actually in your tutorial question as well, right? So CGT event C1 occurs where a CGT asset that the taxpayer owns is lost or destroyed, right? Well, you might think, well, how can you make a capital gain when that happens, right? Well, we're talking about the scenario where you receive compensation as a result of the loss or destruction of an asset. The compensation often is an insurance payment, right? So how can you make a capital gain? It's if the capital proceeds, and the capital proceeds, it's the compensation. It's if the compensation for the loss, right, is greater than the cost base, right? So it is possible, right? I think oftentimes you might not make anything because the insurance payment may not cover your cost in some cases, but if it does, right? So if the capital proceeds, often compensation, are greater than your cost base, then you have a capital gain, right? And if it doesn't cover your cost, right, then you have a capital loss. That is directly relevant for your tutorial question, okay? So you'll get a practice of that. CGT event D1, what's this about? CGT event D1 occurs where a taxpayer creates a contractual or other legal right in another entity, right? So what's a scenario? Now, a good illustration are restraint of trade clauses, which you see in sale of business agreements, and you might have come across them in commercial law. When a person sells a business, right, say it's a hairdressing salon, for example, it's very common to see a restraint of trade where in that sale of business agreement, the vendor, that is the person selling that business, promises the new purchaser, well, that I'm not going to operate a competing business with you within, say, a 5-kilometre radius for a period of 5 years, right? That's very common in sale of business agreements. Now, it could be, right, that the vendor, the seller who has made that promise, right, might, in some circumstances, right, be given a specific payment for that promise, right? And if they have, then there's a capital gains tax issue there, right? So now, what is the cost base? Like, what are the costs you can subtract there, right? Because the capital, here what we're talking about is someone making an economic gain, a capital gain, from agreeing to a restriction of their normal rights by agreeing not to compete within a certain area for a certain number of years. Well, the costs are going to be very minimal here. The costs are incidental expenses, and usually that's lawyers' fees. We hope it's not too much, right? So say it could be that a vendor receives $10,000 for their promise not to compete, right, for a certain period, and it could be the legal fees are $1,000, right, relating to that agreement. So there, then the capital gain relating to that would be $9,000. So inevitably in that situation, you're going to have a capital gain rather than a capital loss. Okay. I'll give you a page reference as well. Page 333 of your book, which goes through an example. Yes?
I had a query. First of all, the capital loss requirements to basically substantial capital loss seem a little bit relaxed, right? First of all, because if you have a reduced cost base, it's easier to fall below that than if you have a normal cost base, because then the difference is higher.
Oh, we'll go through. Look, I don't know. Well, once we outline what's in the cost base, what's in the reduced cost base, I don't think it's more relaxed, right?
Is that my question?
Yeah.
I mean, technically it is, because then you have a cost base of 100. If you take out I've read a little bit about it. If you take out the third component of the cost base, there's 5 elements, right?
Yeah.
Take out the third one, and then you check the cost owing to cost of owning the asset. So you take them out, and then you do that. So the difference is lesser, right? If the proceeds were 50, the cost base is 100, and the reduced cost base maybe comes down to 60. So you were closer to getting a capital loss advantage over there. First, that entailing that, my question was, what's the rationale behind actually relaxing that and giving people that opportunity to get the capital loss to absorb it with the capital gain later on?
Well, when we go through it, you'll see with the reduced cost base, it's no advantage actually. See, we can talk about it more as well if you want afterwards. That it's not the case, because the thing is, with a cost base, as a taxpayer, you want it to be as big as possible, right? You want cost base to be as big as possible because cost base reduces your capital gain, right? With the reduced cost base, and let's look at it when we get to it, but the government, by not allowing you to claim element 3, it means your cost base is less. Is that good for the taxpayer? No, right? Because it means they'll have a bigger capital gain. So it's more efficient when we get to it. Okay, you can, yeah. Yes. Right. So now this is just giving you a sense of other provisions, right? Now it's a for your information slide, right? Not going to examine you on trusts, these lease transactions. You can know that it exists. Now, we were talking about lease premiums, right? That is event F1, right? So it's going to be a capital gains event, right? And you'll be able to subtract incidental expenditure, right? But I'm not going to examine you on that. So it's for your information, just so you know there are lots of CGT events out there. Right. Now, I think we will cover, perhaps we will cover this slide, maybe another slide, and then take a short break. Okay. So CGT asset, right? In order to have a capital gain or capital loss, in order to be within this regime, we have to be dealing with a CGT asset. Okay. In general, that doesn't mean very much, because just about anything you imagined is an asset, or sort of in an economic sense, is an asset for CGT purposes. It's defined really widely to mean any kind of property or legal or equitable right that is not property, right? So it includes goodwill, right? An interest in a partnership, right? This is really wide. This is certainly with an interest in a partnership. Under the common law, we would not regard that as an asset as such, or as a definite form of property, right? So it's really wide. Actually, the CGT asset concept, where it's relevant and useful, is where the law has specific rules for certain kinds of assets, right? And the ones where you should know the special rules are, it's in relation to personal use assets and collectibles, which are coming up, right? Now, Subdivision 108D of the 97 Act, right, it has some special rules. It's in relation to what we call in law fixtures, right, where you've got buildings attached to land, right? Now, normally in the law, if you've got buildings on land, you treat them as one package. You don't separate the buildings from the land for the legal analysis, normally. But in tax law, you do sometimes. You do sometimes have to really apportion values between the building and the land. So when might you need to, right? Now, if we consider the scenario, which probably applies to well more than a majority of transactions now, if you've got land acquired on or after 20th September 1985, right, you treat the building as a separate CGT asset, and you have to apportion, right? You have to apportion values between the building and the land if the depreciating asset or research and development balancing adjustment provisions apply to that, right? Now, we're not going to go into research and development provisions here in any detail in this course. We will talk about depreciation, right? So it is possible to depreciate buildings, right? And so, I mean, that will happen. You will have an entitlement to do that if you are using the building to generate income. And certainly businesses and others who are using buildings to generate income, they can depreciate, right? Now, the thing is, if you're doing that, though, and for CGT purposes, if there's a sale, these are treated as separate CGT assets. Separate the building from the land, and you'll have to work out the capital gains position separately. Now, if you have land and buildings that were both purchased before 20th September 1985, it's really nice and simple. That it's just going to be exempt, right, if you sell it. Now, if you have the situation where the land is purchased before 20th September 1985, but you construct a building or improvement after 20th September 1985, then you have to apportion again, right? And CGT will apply to the building or improvement constructed after 20th September 1985. The land portion will continue to be CGT free. I think that would make sense as a matter of logic, yes. That'll be separate if it's movable, right? No?
For example, air conditioner or some big central conditioning unit
Yeah,
can be removed
yeah,
from the building.
yeah.
Is that also separate CCTV asset or will it be visible?
Oh, okay. I have not considered that specific issue. I would, so is it attached to the building?
Attached with removable. I mean, it's there with the building, but it's removable. If it's not removable, then there's no question that arises. It's removable.
Yeah, if it's removable, then I would say it's a separate CGT asset. Right, so let us, well, let us see what the time is exactly to think about our break. Yep, I think it's time for a break, so 5 minutes, yeah. Hi.
Finally,
Yes.
the lecture.
Yes.
Do you know, can I ask you the
Yeah.
making a capital loss lesser?
Oh, thank you. All right, we will have to start. It's a bit more than 5 minutes. So we'll have to start so we can get close to the end. Right. So now what we're going to do is look at specific kinds of CGT assets, right? Personal use assets and collectibles, right? Special rules apply. These are defined terms. What is a personal use asset? Thank you, Redeemer. As its name indicates, a personal use asset is an asset used mainly for personal use or enjoyment. If you have bought an asset for investment or for income generating purposes, it's not going to be a personal use asset, right? A collectible is a subset of a personal use asset, right? A collectible is exhaustively defined in the legislation. There's a list of what is a collectible in 108.10.2, and if you're not in that list with your asset, it's not a collectible. And then it's simply a normal personal use asset, right? So artwork, jewelry, an antique, right? An antique is something, it could be furniture, it could be some other object that is at least 100 years old. Coin, medallion, rare folio, manuscript or book, or a postage stamp or first day cover. That is the law really showing that they're not amending things that don't seem sensible, right? This was very meaningful for stamp collectors, but now these days we hardly have stamp collectors. So it has to fall in that list to be a collectible. The most important items would be, I think, artwork, right? That would be a big one. Even antiques, right? Okay. What are the rules? Well, basically, I think more than half of the time with these, the government is not being very generous to you, right? But anyway, with collectibles, capital gains or losses on collectibles are disregarded, right? That means have no tax consequence if the cost of the acquisition is $500 or less. That's 118.10 of the 97 Act. With personal use assets, right, capital gains are disregarded if the cost of acquisition of that personal use asset is $10,000 or less. Now, is the government actually being generous to you by that provision? No. Because generally with personal use assets that are not collectibles, right, we're talking about things like your fridge, TV, could be your bicycle is an example from your book, washing machine. Are you going to make a capital gain when you sell it, right? Generally, you make a loss, or you may just take it to rubbish disposal. So it's not being generous to you, but very occasionally you could get the situation where you have an asset, it's a personal use asset, and it actually appreciates in value. And you might get the benefit of this. Such a rare situation, I think, occurs in the tutorial problem next week, right? Now, with both of these, right, with collectibles and personal use assets, you disregard non-capital costs of ownership in working out the cost base. What that means is that you disregard element 3, right? You're going to see all the elements shortly. You disregard that. You don't put anything in there. Capital losses. There's a special rule called the quarantining rule that applies to collectibles. If you've got a capital loss on a collectible, it can only be offset against a capital gain on another collectible, right? Okay. Note, however, this quarantining rule only works one way, only applies one way. So if you have a capital loss on an ordinary CGT asset, something that's not a collectible, for example, shares, right? You can use that capital loss to reduce a capital gain on a collectible. In fact, I think that comes up in our tutorial question. And I have once thrown that in a piece of assessment, and the error rate was quite high. Most students didn't realize that the quarantining rule only works one way, only applies one way. Your book makes the point, right? Okay. With personal use assets, you always disregard capital losses. That's unfortunate, isn't it, for taxpayers? Because most of the time we are making capital losses on if we sell them, our personal use assets. And look, that would be a great tax benefit to us if we could recognize capital losses on the sale of our washing machine or TV. But the government's just said, no, we can't have that, right? Now, then there's a rule if your collectible or personal use asset is a set, like it could be, a set of books, tea set, or, a set of plates, right? You treat that whole set as the asset, right? Not each individual book or plate. Right. Now, let's have a look. This is pretty important. Now, that material about personal use assets and collectibles, it's pretty relevant to day-to-day life, and it is in your tutorial, and it is sometimes in exams. Now, exceptions and exemptions, so important, I think, to know what is not going to be within the CGT regime. So, as we've already said, generally, CGT events relating to assets acquired before the regime came into place in Australia, which is 20th September 1985. Now, a very important exemption. Look, perhaps it's actually the most important exemption in practice, right? The main residence exemption. This one is pretty well known in the community, right? So that Australians, or anyone living here for any length of times, right, say a number of years at least, has a high awareness that for CGT purposes, there is something called a main residence exemption. That means when you sell your home, you don't have a CGT liability. It's exempt, right? Okay, it's good. Good for taxpayers. Okay, so in order to get this exemption, you must have a dwelling, right, a place where you can live, right? It can be a house, it can be an apartment, it can be even a mobile home, a caravan, but it can't be vacant land, right, in order to get this exemption. If you have been using your dwelling partly for income-producing purposes, for instance, say that you have been renting part of your property, right, and living in a part of it, you will have to apportion, right, and you will only get part of this exemption. Now, there is a very useful provision in the law, right, relating to the main residence exemption. It's to do with absences. I've sometimes put this in take-home exams, right. Now, a taxpayer can treat a dwelling as their main residence during a period of absence, right, when they've left the dwelling, right? Often we think of people leaving the country, or it could be leaving a state, but actually it only requires you, it's very broad in the law, to stop living there. Just to be absent, meaning just to move out of your house, right? That's what we mean by absence. It's very broad, right? And you can continue to treat that dwelling and the whole block of land where the dwelling is as you can continue to claim the main residence exemption in relation to it, provided you're not claiming the main residence exemption in relation to any other property. You can only have one main residence at a time for the purpose of this exemption, right? So it's easier to think of sort of a fairly common scenario in which this arises of take a person that they are actually, say, moving overseas for a while. It doesn't have to be that, right? By absence, it's much broader. But say, so a person goes overseas for a while, so obviously they're not living in their home anymore. So they can keep claiming this main residence exemption, right? And, okay, if they don't rent out the property, they can claim that main residence exemption. According to the current law, may change in the future, but according to the current law, indefinitely, right? It could be they haven't lived in it for 10 years, but they can claim it, right, the main residence exemption. Now, if they are using that property to generate rental income, which would be the common scenario, why wouldn't you use your vacant property to generate income? That would be more common. You can generate rent for up to 6 years, right, even though you're absent, and still claim the full main residence exemption. Note the full main residence exemption, right? So very useful for people going overseas. Now, in the 2017 budget, so this is going back more than 2 years now, the government announced an intention to remove the main residence exemption for foreign and temporary residents, right? It's that scenario I sort of referred to of, say, there's a house in Australia that you lived in, but you go overseas, say you've been overseas for ages, say 10 years. I mean, according to the current law, say it's vacant, it doesn't matter that it's 10 years, you can get the full main residence exemption. But the government in 2017 wanted to remove that if you're a foreign resident, right? But what is the status of that bill, right? A bill is a draft law. It didn't pass in the parliament. Why? It was very unpopular. Who was it unpopular with? Australian expatriates. They were complaining no end about it, right? The thought that they're going to have this CGT liability, which they didn't think they would. Now, the relevant bill, the status of it, it has lapsed, right? It's the government has made, I think, more than one attempt to try and get it passed. It can't. So it's not law. We don't know its status, but it's gone nowhere. Right. More exemptions. Small business. Now, small business, as I said, very generous, the concession, right? It works out to 75% because provided small business has held the asset for at least 12 months, not only do they get the normal 50% CGT discount, they are entitled to reduce that gain by a further 50% so that it effectively becomes a 75% discount. And note, a company, as I said before, a company that is a CGT small business entity, right, and that would mean that they need a turnover, that is revenue, no greater than 2 million per year, right, they would qualify for this concession and they'd get a 75% discount. Personal use assets and collectibles, it's what I've gone through. There are special rules that apply, right? Cars, motorcycles, valid decorations, capital gains losses disregarded. I'm not going to examine you on that. That is for your information. The next one for your information as well, but it's worth noting. Assets producing exempt income. Capital gains losses are disregarded. For the same rationale that the ordinary income is exempt, right? It's safe. We're talking about charities. Not only is their income exempt, if they make capital gains on the sale of assets, that is exempt and capital losses are disregarded, right? Now, sometimes it could be that you wonder in relation to a receipt, is it a capital gain or is it ordinary income, right? It's one or the other, right? Now, it's not going to be both, right? I mean, there's no double taxation. So you apply the law and come to the conclusion what is more reasonable here based on the legal rules, right? Now, also note there are special rules that apply in relation to the sale of trading stock, depreciating assets. Now, we'll cover that when we get to depreciation. If you've got assets where you've claimed depreciation and you sell it, it's not going to come under the capital gains regime, right? There will be a balancing adjustment, right? There will be a tax consequence, but it's not going to come under the capital gains regime. Deceased estates. Now, a person's death does not have any CGT consequences, and there are no CGT consequences when assets pass from the deceased's estate to the beneficiaries under their will. The beneficiaries don't have any CGT liability at that moment. Now, what happens though, it's relevant for the future. At the date they acquire the asset under the will, by acquire we don't mean that they pay for it, but when they become legally entitled to it, as at that date, they are deemed to have, in law, acquired it for market value, right? And that'll be relevant for future transactions. Say the beneficiary down the track, it could be years later, sells that asset that they acquired under a will. Now, in working out the cost base, the acquisition cost will be deemed to be the market value when they inherited it, right? Okay, now we're going to go through some rules in relation to capital proceeds. I think you know the main point already. So with some of the detail, I might go through it reasonably quickly because I don't think it's difficult, and I think it's more important here to know the main point, which applies most of the time, because I really would like, if we possibly can, I don't know whether it's possible, to get to that example, right, at the end. Okay, so with capital proceeds, right, what is it? What's the definition? I mentioned this before. It's the money, right, and or the market value of any property that you receive in relation to the CGT event. Most of the time we're talking about just money, right? You sell land, you get cash. That's most of the time. But it could be sometimes it's a non-cash benefit. If so, you've got to value it, and that's your capital proceeds amount, or it could be a combination, right? Now this would apply to businesses, right? Not to individuals, right? If you'll see that when we do GST. If part of the capital proceeds, right, include GST, goods and services tax, because the person selling is required to send GST to the government, right, then what counts and what is included for tax under CGT is the capital proceeds minus the GST, right? You're not taxed twice, right? Okay. Now, let's have a look at some modification rules. I think probably the very important modification rule to note is the market value substitution rule. It's in 116.30. Now, capital proceeds, it's all division 116 for that governs that. Now, what is this rule? It says that, well, if there are no capital proceeds received by you, but you've sold an asset to someone else, you don't get anything, right? Or some of the capital proceeds, or all of them, cannot be valued, or, and this is another condition, or another scenario in which this consequence will apply, or the capital proceeds you get are more or less than market value, and you are dealing with each other, someone not at arm's length. That means you're dealing with a family member or a close friend. In all those scenarios, all those three, right, they don't all have to apply. What we mean is it could be there are no capital proceeds, or some can't be valued, or you're dealing with your your family member or close friend, and you're not paying, you're not receiving market value. In all of those situations, the law deems you to have received market value. That is the market value substitution rule. Let's take a simple illustration. A parent transfers land to their child as a gift, right? So the child doesn't pay anything, right? The law deems there to be capital proceeds, the market value, right, of the land. So that parent will have a capital gains tax issue, right? Gifts come within capital gains tax. Now, further modification rules, apportionment, right? It could be sometimes that a transaction relates to the sale of more than one asset, right? That's really the situation we're referring to. You have to apportion between the two separate CGT assets. So, and deal with them separately. So, for example, say that a person sells land and shares for a lump sum payment of $500,000, right? So the land and the shares, they're treated in law as separate CGT assets. That means you've got to apportion, right? You have to ascribe some value to the land and some value to the shares. Now, as I think a former student told me, actually, I'm going to ask you, and how about let's hear from someone who hasn't said anything yet this lecture, right? Right, so there's a lot of people to choose from that. If you're trying to apportion the capital proceeds between land and shares, which one do you think you'd apportion or ascribe value to first? The land or the shares? What would be most reliable? Shares? Shares, yeah. I mean, without me even talking about the point, a student mentioned that last semester, and I thought, yeah, absolutely, you would do that. Shares, we've got far more accurate information as to what is okay, that is if they're listed, right? Could be totally different if we're talking about shares in a private company, right? But if we're talking about listed shares, we can just look at the ASX and we know that market price, right? It's reliable. So you describe value to the shares and then the difference is the land value. Non-receipt rule, what does this mean? If in relation to a credit transaction, it's the case that you think you're not going to receive part of the capital proceeds, right? Essentially a bad debt situation, then you can reduce the capital proceeds, right? There's an example in your book at page 359. Repayment rule. Now, this is another situation in which you can reduce capital proceeds. There's a nice example in your book. Oh, I haven't got the page number, but it's probably soon after 359. Now, say that you have a seller, okay, they've sold something, say it's a painting, and they have misrepresented, for example, who painted the painting. And then that means they have a legal claim that the purchaser sues them and they have to provide some compensation to that purchaser. And so actually they're getting less in terms of capital proceeds because of their misrepresentation, right? They've done something wrong. But in terms of their tax position, what it means is they can reduce the capital proceeds, right? The assumption of liability rule, right? Now, what that is getting at is this. Say you sell an asset, say it's land, right? And the purchaser, they not only pay you for the land, right? They also agree, and this is very unusual, right? But the tax law covers all the scenarios. They also agree to take on the liability under a mortgage on the land, right? So say in this particular example, a person sells land for $200,000. It is subject to a mortgage of $50,000. The purchaser agrees to assume liability under that mortgage and pays, well, really the economic benefit that they're giving the vendor is $250,000, isn't it? Because they're taking on the mortgage liability. So in that situation, the capital proceeds are $250,000. Now, that is very unusual. Normally, I mean, it's very common for, in the lead up to a sale, that there's a mortgage on property, but the usual scenario is that the purchaser still gets unencumbered title without any mortgage because it all happens on one day. The vendor uses the purchase monies received to pay off the mortgage. The lawyers do it all on one day at settlement. Now, let's have a look at cost base, which we have talked about to some extent already. So what I've said is the cost base, it's a very comprehensive concept of, you know, all the economic costs associated with the asset. So in element 1, we see acquisition cost, right? That's the money you paid, or if you gave some property as well, it's also the market value of any property you gave to acquire the asset. Now note, you know, I'm calling them, you know, element 1, element 2, element 3. That is the terminology that's used in the law. So in your exam answers, you should go into that detail of, you know, this is claimable under, you know, element 1, right? You don't even have to write a full sentence, but in brackets even you can say element 1, element 3, whatever applies, right? That shows understanding, right? So, I often don't need such a huge level of detail as to provisions, in the sense of with cost base, it's sufficient for you even to say it's 110 without going to the absolute level of detail of the provision, but to break it up into, or to identify which element is relevant really shows understanding, so do that. Now, element 2, incidental costs, right? These are costs that you incur on the purchase of an asset or on the sale of an asset. With the sale of land, there are always incidental costs, right? So that's a good example. So if we're talking about land, when you buy land and when you sell them, often you've got lawyers' fees invariably. You may have advertising costs if you're selling land, right? Stamp duty when you're buying land, valuation fees, cost of transfer, search fees, a lot of incidental expenditure in relation to the sale of land in particular. So that's what we're talking about. Now, element 3, right? This is the one where sometimes you don't get it at all, right? And this is the one that doesn't appear in the reduced cost base. It's something else that the Parliament tells you about element 3, but effectively you don't get anything for element 3. And in fact, it was not there in the original legislation enacted in 1985. It only was introduced into the law in 1991, and it only applies to expenditure after 20th August 1991. It's often known as non-capital costs of ownership, right? And what do we mean? It's things like interest on a loan used to buy the asset, right? Repairs, insurance, land tax, right? Now, note one thing though. Say in relation to a property that you are using to generate assessable income, such as rental income, generally with interest, right, where you've borrowed money to buy that property, you would generally be deducting that every year against your rental income, right? So if you've been doing that, you can't claim it again here as part of element 3 of the cost base if and when you sell that property, okay? Element 4 of the cost base, capital expenditure you incur to increase or preserve the asset's value. So here we're talking about structural improvements, you know, for example, renovations. 5 hardly ever comes up. This is capital expenditure you incurred to really defend your right to this asset, that you are the owner of it. So it's really talking about the situation where you've got a legal dispute with someone. Now, reduce cost base. So we did talk about this, and so I hope now everyone can think about it after the lecture, but it is the case, and think about it if it doesn't seem clear initially. Reduce cost base for the taxpayer, it's very similar to cost base, right? 1, 2, 4, and 5 are the same. We don't need to repeat what we've said because it's the same. But the thing is, we don't have element 3, right? You cannot claim non-capital costs of ownership. I'll tell you about the sort of the strange thing that the legislation says there, which will be a for your information point because it is kind of hard to understand, and I think it's a legislative drafting flaw. But basically, you know, things like interest expense, repairs, insurance, land tax, which we mentioned for element 3, for cost base, we can't claim any of those things in our reduced cost base. So reduced cost base is a concept, right, that applies for, it is the relevant notion of cost for working out if you have a capital loss, right? So, you know, I mean, you can work out, right, in relation to any asset, you can work out your cost base, you can work out your reduced cost base. It will be similar. Reduced cost base, it will not have element 3, right? Now, and to know whether you have a capital loss, it would need to, the situation would have to be that your reduced cost base, that would have to be greater than your capital proceeds, right? Now, as a taxpayer, you want the cost base to be as big as possible, right? Because if the cost base is bigger, that means your capital gain is going to be less, right? And you have more of a chance of getting a capital loss. So, look, they're similar, but the fact that we can't claim element 3 amounts means, well, that's not good. We'd prefer if we could, right? Now, in relation to this, the bizarre wording I think the legislation uses, it is literally what I've copied here, right? I've abbreviated assessable income, but it's what the legislation says. And I'm not going to give you a question that really requires you to apply that because it's so strange, the words in the legislation, and your book doesn't really explain it, or nor have I seen any other book that explains it properly. But basically, if you're interested, there's an example at page 364. Now, so the points are you definitely can't claim things like interest, rates, any other non-capital costs of ownership. And in addition to not being able to claim those things, if it's a situation where you have claimed capital works deductions, that is the example used at page 364 of your book, right? And I think it's basically the situation where this statement will apply. It means you basically have to take that amount, and in the example given at page 364, the capital works deductions were, I think, 30,000, right? You take those capital works deductions and you actually use that to reduce your cost base, right? So we don't like that. We don't like to reduce the cost base because we want the cost base to be as big as possible, right? So that's how it works. It is a for your information point. If you're interested, have a look at page 364. I will not examine you on that because I think how the legislation is drafted doesn't make any sense. It says you include an amount. You include an amount there that you but what it's not about including. It's actually about subtracting. So very confusing. So main point, only point you need to know for the exam is that you can't claim element 3 items, which you could for cost base. Now, let's look at modifications to the cost base and reduced cost base, right? This is going to go through this quickly because it's basically mostly the mirror image of the modification rules for capital proceeds. So we've got a market value substitution rule here too, right? So if you didn't incur any expenditure to acquire an asset, or some of the expenditure cannot be valued, right? Or you didn't deal at arm's length with the person from whom you got the asset, then the law says you're deemed to have paid market value. But actually, I think you would like that, right? Whereas with the capital proceeds situation, you know, a parent that gifts land to their child, they don't really want to the position where they're deemed to have received market value because that gives them a capital gains tax issue. As the person receiving the gift, actually, you want the law to say that the position is you are deemed to have acquired it at market value, right? Because if and well you sell it down the track, you want a cost base. You would like that, right? If we didn't have this rule, it means if you got a gift, and say a gift of land, and then you sell it sometime, it means if we didn't have this, it would mean your cost is zero. You don't want that. You want a cost base, because it will reduce your capital gain, if you have one. Now, split or changed asset rules. So this is useful and sensible. This happens, with companies, not infrequently. Share splits, right? The law says a share split is not a CGT event, right? So makes sense because nothing is happening economically, right? So if one day you own 10 shares in ABC company valued at $1 each, the next day the company undertakes a share split and you have 20 shares, right? Then it means, look, well, they're valued at 50 cents each. It's not a CGT event. You don't have to do anything with your taxes, but you do need to make a note. It's just a notation for your records that actually you've got now 20 shares at 50 cents each, because this will matter for you working out your position later when you sell. It's not any economic consequence, but still you need to know, right, what the new acquisition cost is. Now, the apportionment rule here, it's similar to what we saw in the context of capital proceeds. So, if you buy land and shares from C, right, B purchases from C for a lump sum payment of $1 million, okay, so suppose the shares have a market value of $200,000, right? And that is, if we're talking about listed shares, that's the one which you would value, as I said earlier, because we've got a market, which tells us what the price is. Then the land value there is $800,000. Now, the assumption of liability rule, it is absolute mirror image, right? If, as a purchaser, you pay, say for land, you pay not just a sum of money, but you acquire the liability under a mortgage, to calculate your cost base, you can include that liability under the mortgage. So just look at the previous example, right? So that it was like a $50,000 mortgage, you'd include that as part of your cost base. All right. Now, exclusions from the cost base, we've made this point before, you can't claim twice. If you have been claiming deductions for expenditure, for example, for interest expense, right, in relation to an income-generating asset, then you cannot claim that as part of the cost base again. Input tax credits, this relates to the GST regime, right? We won't say too much about it here because you don't know about that concept, but basically, until we do that, but basically, what input tax credits are refunds of GST for people in business, for companies and individuals in business. Now, if you've got a refund of GST in relation to an expenditure you've made, then in terms of, what is included in the cost base, you've got to subtract that input tax credit. All right, now the discount, so important. It's so important, but it's not difficult, right? It's a great benefit for taxpayers, individuals, complying superannuation entities, trusts, and life insurance companies are entitled to the CGT discount, which is in subdivision 115A, and the amount of the discount is, the normal amount is 50%, right? That's the baseline amount for, but it's 33.5% for superannuation entities and life insurance companies. We will only deal with individuals, we will deal with trusts later on, and note what I said about companies that are small business entities, right? CGT small business entities, they can get 75%. Or even individuals, right, running small businesses can get 75%. Now, the CGT discount, it's not available for foreign and temporary residents. That was withdrawn on 8th May 2012, right? Now, in terms of the history, it's pretty interesting. The discount was introduced in September 1999, specifically 21 September. Before that, there was indexation. Indexation means that you can inflate or increase the cost of property or any other asset to take account of inflation, right? So indexation is something that, of course, you like it. Anything that enables you to increase the cost, you like, because that reduces your capital gain. Now, the thing is, as a matter of government policy, in September 1999, law was enacted really to phase out and get rid of indexation. But we're still dealing with indexation because we still have assets that were acquired before 21 September 99. But the thing is, indexation is never compulsory anymore. It's only ever an option, right? So the rules are as follows. If you're dealing with an asset acquired after 21 September 1999, then your only option is the discount if it's available to you. And note, a condition for getting the discount, and it is a condition for indexation as well, is that you must have held the asset for at least 12 months, right? It's only a theoretical condition for indexation now, because if you are thinking of indexing the cost base of an asset acquired before 21 September 1999, of course you've held it for 12 months, you've held it for 20 years, right? So that's why it's in theory. Now, but note that option of indexation, it's only if you acquired before 21 September 1999. Even if you did acquire before 21 September 1999, you can choose the discount, right? So if your asset is 20 or more years old, you've got this choice. You do whatever is better for you, the discount or indexation. If it's after 21 September 1999 that you bought the asset, only possibility is the discount, if it applies. Right. So, yes, and you can only choose one or the other, right? Oh, I mentioned these points. Oh, I'm so glad we can look at the example. Now, because I did want to get to this, because how the lectures and tutorials are structured this year, that you've basically had your tutorial before. Most of you have had your tutorial before the lecture, so you're going to do a big CGT question next week, but I wanted to at least give you, a more straightforward scenario to expose you to the key concepts in terms of the application of the theory. So, right. We do have a few minutes. Okay, can you look at it? Can you try to work it out? So we have 5 minutes. Now, let's see. I'll give you some guidance, right, to help you along. So we're dealing with a disposal, A1. And so she's selling her holiday house, right? Okay, holiday house. It means she's got another house, right? So it means don't think of main residence exemption, right? There's going to be a CGT liability. And this is giving you the amounts that you need, right? It will give you the capital, there's the capital proceeds amount there, and then look at all the costs, right? And where would they go? Think about where they fit in terms of the elements. And basically, we're focusing on one transaction here, right? And there's a loss from a previous year, and so you need to think about whether you can use that loss to reduce the gain. So the capital gain, if there is indeed a capital gain, right? Well, very clearly there is. If we look at what she has, paid, $200,000 in 1988, right? And really not much in terms of expenditure. So of course there's going to be a gain, quite a big gain. So it's capital gain is capital proceeds minus cost base, right? And in cost base, break it up into the elements. Element 1, element 2 is going to apply. There's incidental expenses there. Incidental expenses related to purchase and sale, right? Is there anything else? Is there anything else in terms of the elements? Then you get to your capital. It's not difficult to see, right? You can see straight away there is going to be a capital gain amount. Then you think about losses. Oh, see, our order is so important, right? You've got to think about losses before you think about the discount. Okay? Then you think about losses, and then you think about, well, can we discount, right? Well, here you could actually think of indexation because it's purchased such a long time ago, before 21 September 1999. But the solution I'll present to you only looks at the discount, right? I think most of the time the discount is better, yeah? No, it's okay.
Why don't we establish indexation as a compulsory thing for assets of what's so long back, what's the rationale again? Isn't it logical to index it? Why would the law keep it optional per se? And if optional, why would we not index it most of the time?
Yeah, Tanish, it's a good question. Now, in particular, and look, I'll just take a second to answer this, but then I hope others can sort of either listen or keep working. The rationale, yeah. Look, indexation makes sense, right? It makes a lot of economic sense. As a matter of government policy, I'm not saying it's logical, but some things are just done as a matter of policy. That the government decided it's going to give some kind of compensation, but it didn't give it to everyone. It doesn't give it to companies normally, and that's the discount, right? It's very rough. It's not logical. It's just a fairly arbitrary. Indexation makes a lot of economic sense. So can return to that, yeah? And so how are we doing